Hey, good morning, everyone. Marty Mazzora here, the 3rd of September 2019, Tuesday, with your pre-market update. I think I can keep this one quick. I shared a lot with you over the weekend, talked about some of the data that's been weighing on our own macro index, talked about futures traders positioning in various currencies and commodities and what that says about how futures traders feel about macro conditions and how it impacts the items that they happen to be trading and so on. So this morning, I think we'll just jump on the chart, spend a couple minutes and let you go. In Sunday's blog post, I made reference to where futures were trading now that the new tariffs have been put in place on both sides. And I'll show you this again in the daily chart in a second, but if you remember that rally last week, I thought was predicated on the prospects for actually delay of the weekend tariffs, which is what China was asking for. So we didn't get that, and futures rolled over. The S&P was trading below 2,900. It bounced back to a range of between 2,903 and 2,912. And then I talked about the Chinese yuan and the dollar fixing, and I kind of explained what they do there. Talked about Chinese manufacturing PMI coming in better than expected. So a couple of positive things that pushed the S&P up above my range. And I kind of put those into context and said, it wouldn't surprise me to see us come back into that range, 2,903 to 2,912, if not lower, come the open Tuesday morning. Well, here we are 6 minutes before the open, and we're right at the bottom of that range at 2904.50. So still, lower end of the range, popped down below it here just a minute ago. And this market is very volatile. Of course, it's all over the place, as you noticed. In yesterday's blog post, I pointed to this big red candle that you see here, and that came on news that they don't really have anything scheduled in person for September, and they don't know really what to talk about because both sides seem to be very entrenched in their positions, and they happen to be in areas that neither side is willing to give on just yet. So we came barreling through here, bounced back off of that, and again, here we sit right now, 2904.75. That would be a 20-point decline or so in the S&P, a couple hundred points in the Dow. As you can see, it was just the last few minutes that the market really traded lower. And I can see the headline that just came across: Trump pressures China to make deals soon, or it'll get tougher if he wins next year. So again, that's the kind of language that China's been saying you need to stop coming with. And as I mentioned over the weekend, their stronger manufacturing PMI could just kind of embolden them, along with their willingness to stimulate and so forth. And then the messaging from President Xi over the weekend was, let's just buckle down and expect a long fight. So we'll see how this plays out. As I keep suggesting on the blog, macro conditions are not good. Under the surface, as I illustrated for you, some of the key forward-looking data is really rolling over. If the consumer rolls over with it, I think we have a tough go of it going forward for a while, folks. I do think this market amazingly holds up near all-time highs because it's viewed that these issues are really all around the trade dispute, and the political damage done by the trade dispute make it very low odds that it's not resolved by this time next year. The question is, how much deterioration is allowed to go on between now and then, and do we get to that inflection point where it's simply too late? We roll over into recession. We have some huge disruptions in the credit markets, which I've been talking about a lot lately in terms of where the risk lies. And it's concerning me all the more I look at it. We have a recession right now with limited tools at the Fed's disposal, and I think with limited fiscal tools after the recent tax cuts and so on. This could be a doozy of a recession. So these are my concerns. I'd love to tell you a better story, and I will be happy to the minute a better story emerges. But that's the only story I can legitimately tell you, at least for the moment. Okay, to wrap up, here's our daily chart. Again, I think traders in here were expecting a delay to the weekend tariffs. The close on Friday to the open this weekend in futures, you can see we didn't get that. So we remain stuck, very much so, in this trading range. We will ultimately break out of it one way or the other. If we break out with some momentum, shorts will cover. You'll get a nice pop higher. break out below certain levels here, stops will get hit, ultimately some margin calls, and then it gets really messy to the downside. Could go either way. Right now, of course, it's not looking so good. There is the real potential to get kind of a waterfall sell-off in here. So just to kind of set your expectations, doesn't mean the end of the world, doesn't mean a bear market, just means that we won't sit up in here, I don't think, a whole lot longer. I would bet we're probably within days of a breakout in one direction or the other. If we break out higher, it could be exaggerated with a lot of short covering, but without some really good news, it feels sustainable. Of course, that has to be the ending of the trade war with China, rolling back of all the tariffs that have been added in the process, and then a real commitment not to go at it this way with the rest of our trading partners. As I keep saying, we could end the trade war with China and just keep that uncertainty alive with the threats of tariffs in other parts of the world. There are issues out there that need to be dealt with, but I'm hoping that the powers that be have gotten the message that we've got to find other methods of addressing those issues other than the utter disruption of global supply chains and increase of cost to consumers and everything else that goes with it. Thank you as always for watching and listening. Stay tuned. I'll be back with much more. Take care. Bye-bye.